What happens when the price on your screen becomes a lie? On December 29th, silver traders watched their monitors flash a crash from 84 hours to $72 an hour. But that number was a phantom. Because on the same day, in Shanghai, the same ounce of silver traded at $78.49, with buyers paying an $8 premium on top. Two prices for the same metal. This isn't a market glitch, it's a fracture. The financial system is splitting into two realities. One for paper promises, and one for physical metal that actually exists. This divergence isn't about speculation. It's about the credibility of the entire Western financial structure. When the paper price disconnects from physical reality, the system is telling you it's broken. That $8 premium in Shanghai is the most important number in the silver market right now. It's not retail investors overpaying. These are sophisticated commercial buyers, refiners, manufacturers, in the world's largest silver market. They are paying real money for immediate delivery because they no longer trust the promise of future delivery. That premium is a direct signal of supply stress. When buyers compete this aggressively for metal now, it means the system for delivering it later has failed. This divergence isn't confined to Asia. The cracks are appearing in our own institutions. The Bank of England, the cornerstone of London's precious metals market, now requires 4 to 8 weeks for silver deliveries that used to take 48 hours. Let that timeline sink in. The vault system designed for instant settlement now needs up to 2 months to locate and deliver metal. In late January, Bank of England Governor Andrew Bailey was questioned by the UK Treasury Committee about these systemic delays. His testimony was evasive. He acknowledged the problem but offered no clear explanation for why one of the world's premier financial institutions can no longer perform its most basic function. When a central bank governor can't explain why the vaults are failing, the mechanism itself is broken. The math is simple. When buyers pay a significant premium for immediate delivery, they are voting with their capital. They are saying, the paper contract, the futures price you see on your screen, is no longer a reliable claim on real goods. This creates a feedback loop. As the premium grows, the incentive for anyone holding a paper contract to demand physical delivery and sell it into the higher-priced physical market grows exponentially. But there's a catch, and it's where the trap is set. The system is designed to make that arbitrage nearly impossible to execute, locking you into the collapsing paper price while the real asset value escapes. The December 29th flash crash wasn't an accident. It was a controlled demolition. The Chicago Mercantile Exchange raised margin requirements by 13.6%, forcing leverage traders to post more collateral. When accounts couldn't meet the new $25,000 per contract threshold, automatic liquidations triggered a panic sell-off. The exchange knew this would crash the futures price. They did it anyway. So why would the institution that profits from trading volume deliberately engineer a crash that scares away participants? There are only two explanations. Either the CME sees a systemic risk so severe that immediate, forced deleveraging is necessary to prevent a larger collapse, or they are attempting a preemptive shakeout, clearing the field of smaller players before a more significant event unfolds. Neither scenario is comforting. The result was exactly as intended. Paper prices plunged, creating the illusion of stability and cooling speculative fervor, while physical premiums in Shanghai held firm. This action widened the gap between the two price tiers, making the problem worse, not better. This is the weaponization of risk management. By raising margins, the exchange makes it more expensive and dangerous to hold a position that could lead to a delivery demand. They are actively discouraging the very act that would expose the physical shortage. It's a delaying tactic. They are choosing to maintain the facade of a stable paper price, knowing it is completely disconnected from reality, because the alternative, letting the price soar to meet physical demand, would cause immediate, catastrophic chaos across thousands of industrial contracts and trigger margin calls they cannot contain. The flash crash created the perfect smokescreen. For the average investor watching their silver ETF, it looked like a market correction. But for the commercial buyer in Asia, it was a fire sale on paper promises. Their physical metal became more valuable as the discount widened. This is the two-tier market hardening in real time. The exchange's solution to a physical shortage was to crash the paper market, proving that the paper price is not a price discovery mechanism. It is a control mechanism. And every day they use it, the real price of physical silver slips further from your grasp. To understand why this divergence is a terminal problem, you need to look at the vaults. The official inventory numbers published by COMEX tell a story of collapse. In 2020, COMEX vaults held 346 million ounces of registered silver, metal that is specifically available for delivery against futures contracts. As of late November 2025, that number had collapsed to approximately 113 million ounces. That's a 70% decline in the physical silver, backing the largest American futures market. The foundation has been crumbling for years. But the real alarm bell sounded in the first 4 trading days of December 2025. In less than a week, over 60% of that remaining registered inventory, 47.6 million ounces, was claimed for delivery. Think about the mathematics of that moment. Commercial buyers demanded delivery of more than half the metal backing the entire market in just 4 days. That's not trading, that's a run on the vault. When sophisticated players suddenly demand physical metal instead of rolling their paper contracts forward, they are sending the clearest possible signal. They don't trust the system's promises anymore. They want metal in their own vaults, under their own control. This behavior shatters the fundamental assumption that allows futures markets to function with minimal physical backing. The system operates on the premise that only 2% of open interest will ever demand delivery. The rest will cash settle or roll their contracts. But what happens when that percentage jumps to 5%? Or 10%, the math becomes catastrophic. With COMEX open interest recently at 244% of vaulted silver, the system is a house of cards. For every ounce of metal available, there are 2.4 paper claims on it. If just 2% of those paper claims demanded delivery, the registered inventory would be completely exhausted. We have already seen delivery demands far exceeding that theoretical breaking point. The system is operating with zero margin for error. The run in early December was a warning shot, proving that the demand for real metal can overwhelm the paper structure at any moment. The only thing preventing a total failure is the belief that it can't happen. But the vault data proves that belief is a fantasy. While COMEX was bleeding inventory, the other major trading hub was facing its own existential threat. In October 2025, the London vault system faced a crisis so severe it required an emergency airlift. A staggering 53.88 million ounces of silver, roughly half of what COMEX currently holds, was imported from New York, Shanghai, and other international sources to prevent outright delivery defaults. This wasn't a routine transfer, this was a bailout. The trigger was a simple, devastating statement. According to multiple reports from that period, JP Morgan, one of the world's largest precious metals dealers, told major Indian clients in mid-October, "We don't have any silver to send." Let that statement settle. A financial institution with over $3 trillion in assets could not locate silver to fulfill client orders. These weren't retail customers buying coins. These were major Indian bullion dealers and manufacturers being told the metal simply wasn't available. The entire London mechanism seized up. The October crisis forced a desperate global scramble. Vault operators pulled metal from New York, creating a drain on an already stressed COMEX system. They sourced metal from Shanghai, even as Chinese buyers were paying premiums for every ounce they could get. This emergency measure patched the hole, avoiding a public default that would have exposed the system's fragility to the entire world. But emergency measures are not solutions, they are delays. They buy time without fixing the underlying problem. Global demand is structurally exceeding available supply, and the vault system was never designed for this level of physical pressure. The London emergency matters profoundly for American investors because these markets are not isolated, they are interconnected arteries. When London vaults run short, they pull metal from New York, weakening the COMEX foundation. When Shanghai offers higher prices, metal flows east, away from Western vaults. When JP Morgan says it has no silver, it means the strain is systemic, affecting every major trading hub simultaneously. Your silver ETF, which may hold shares backed by metal in a London vault, is exposed to this interconnected fragility. What happens when that London vault is shipping its metal to another continent to stave off a default? The security of your paper claim depends on a global game of musical chairs, and the music is stopping. The October crisis wasn't an anomaly. It was a stress test the system barely passed, and the underlying conditions have only worsened since. The market structure itself is screaming the truth that the paper price tries to hide. Silver has entered a state of persistent backwardation. Normally, a futures market is in contango. Future delivery costs more than immediate delivery because of storage and financing. But when that relationship inverts, when the price for metal right now is higher than the price for metal in 3 months, it signals a fundamental breakdown. It means commercial users are so desperate for immediate supply that they'll pay a premium to avoid waiting. They aren't speculating on price. They are trying to keep their factories running. This desperation is quantified in the lease rates. During the most acute stress periods, the rate to borrow physical silver for a short time has spiked to an annualized 200%. Think about what that number means. A borrower is willing to pay double the metal's value and interest just to have access to it for a few months. This isn't a financial trade. This is an industrial user who has a production line to feed, a contract with a solar panel manufacturer, a hospital waiting for medical equipment. They will pay any price, accept any term, because the cost of shutting down is far greater than an exorbitant lease rate. The shift changes the entire character of the market. For decades, silver trading was dominated by financial players, speculators, ETFs, hedge funds. The price was set by paper flows. But now, the industrial users, the ones who actually consume the metal, are being forced to the forefront. They are bidding against financial traders for a shrinking pool of real supply. And when a manufacturer who needs silver to build a tangible product goes up against a fund manager who only needs a ticker symbol, the manufacturer will always win. They have to. This is the market transitioning from a casino to a genuine battlefield over scarce resources. The backwardation and the lease rates are the financial fingerprints of that battle. Now, connect these dots. Don't look at them as isolated incidents. See them as pressure points on a single, overstressed system. COMEX inventory collapses by 70%, and then 60% of the remaining metal is claimed in 4 days. At the same time, London requires an emergency airlift of 54 million ounces, because JP Morgan can't source metal for its clients. Simultaneously, Shanghai buyers pay an $8 premium. The Bank of England delays deliveries for 2 months, and the market structure locks into backwardation with lease rates at 200%. This isn't a coincidence. This is coordinated systemic stress. Every major trading hub, New York, London, Shanghai, is showing the same symptoms at the same time. The common denominator is undeniable. Physical silver is becoming unobtainable in commercial quantities at the paper price. The system-wide scramble is the direct result of 7 consecutive years of supply deficits. You can't consume 800 million more ounces than you produce without eventually hitting a wall. The above-ground inventories that acted as a buffer are gone. The vaults are the last line of defense, and they are being emptied. The exchanges are now trapped in an impossible dilemma. Their primary function is to provide price stability for commercial users who budget months in advance. If they let the COMEX price surge to $95 to match Shanghai, it would invalidate thousands of contracts and trigger a financial meltdown. So, they choose the other path. Suppress the paper price through technical measures like margin hikes, but this only widened the gap, making the arbitrage opportunity for physical delivery even more tempting. The problem is, the very delivery delays and vault shortages that create the price gap also prevent traders from exploiting it. You can't buy cheap paper, demand delivery, and sell high in Asia if you can't actually get the metal delivered. So the two-tier market persists, a permanent monument to a system that can no longer reconcile its promises with reality. The perfect storm isn't coming. The data shows it has already arrived. The only question is how long the levees can hold. The exchanges are now trapped in an impossible dilemma. Their mandate is to provide orderly markets and price stability. But they are facing a mathematical reality that makes both goals mutually exclusive. On one hand, they can continue using technical measures, like the December margin hike, to suppress the COMEX paper price. This maintains the illusion of calm for the thousands of industrial contracts and financial instruments priced off the futures market. It avoids immediate, catastrophic margin calls that would ripple through the entire system. But this choice has a devastating consequence. It deliberately widens the chasm between paper promises and physical reality. Every day the gap grows, it erodes the very credibility the exchange is trying to protect. It tells the world that the price on the screen is a managed fiction. The alternative is just as perilous. They could allow the paper price to surge, letting it converge with the real physical price of $95 or more. This would be an honest price discovery, reflecting true supply and demand. But the shock would be instantaneous and systemic. Manufacturers who budgeted based on $75 silver would see their cost structures obliterated. Thousands of derivative contracts would be thrown into chaos. The exchanges would be blamed for a price explosion that disrupts global commerce. It's a choice between managing a slow-moving credibility crisis or triggering an immediate financial heart attack. The margin increase proves which path they've chosen. They are prioritizing short-term stability at the cost of long-term integrity. But here's the flaw in their strategy. By maintaining the artificially low paper price, they create a massive, tempting arbitrage opportunity. In theory, a trader should be able to buy a cheap COMEX contract, demand physical delivery, and immediately sell that metal in Shanghai for a risk-free profit. This arbitrage is the market's natural mechanism for closing price gaps. The reason it isn't happening at scale is the very problem the exchange is trying to hide. The delivery mechanism is broken. The delays at the Bank of England, the scramble for metal in London, the drained COMEX inventories, these physical bottlenecks prevent the arbitrage from working. So the exchange's solution only works as long as they can prevent people from actually taking delivery. They are betting that the system's friction will save them from the system's failure. It's a bet against the fundamental laws of economics. To understand why this situation is unsustainable, you need to look past the daily price movements and examine the structural mathematics. The numbers I'm about to share aren't projections or estimates. They are documented, verified deficits published by the Silver Institute. For 7 consecutive years, from 2021 through 2025, the global silver market has run a supply deficit. The accumulated shortfall over that period reached 800 million ounces. Let that number resonate. That's equivalent to an entire year of global mine production simply consumed without being replaced. We have been eating the seed corn for 7 years. The deficit for 2025 alone is projected at 149 million ounces. This means demand exceeded supply by roughly 15% for the year. Every year, industrial users, investors, and governments consume more silver than the mines can produce. Every year, that gap is filled by drawing down the above-ground stockpiles, the vaults, the government reserves, the recycled scrap. But you cannot drain a reservoir forever. The COMEX inventory collapse, down 70% since 2020, is the physical proof that the reservoir is nearing empty. The emergency airlift to London in October is what happens when the traditional buffers are gone, and even the most powerful institutions are scrambling for scraps. This brings us to the most dangerous number of all, The leverage ratio. Recent analysis shows COMEX open interest standing at 244% of the silver actually held in its vaults. Translate that clearly. For every single ounce of metal available for delivery, there are 2.4 paper claims on that same ounce. Now, this ratio is tolerated in normal times because the system operates on a crucial assumption that only a tiny fraction, typically 1 to 2% of those paper claims will ever be converted into a demand for physical metal. The system is a fractional reserve bank for silver. But what happens when that assumption fails? We already have the answer. In early December, delivery demands hit 60% of available registered inventory in just 4 days. The system was seconds from a breaking point. Do the math with me. If just 2% of the current open interest decided to stand for delivery, the COMEX vaults would be completely emptied. The metal simply does not exist to satisfy those contractual obligations. The system is operating with zero margin for error, a fact proven by the emergency measures we've already witnessed. This isn't a prediction of a future collapse. It is a description of a present condition. The 7-year deficit has created a mathematical certainty. The paper claims on silver vastly exceed the physical silver available to back them. The only thing preventing a formal default is the belief that not everyone will ask for their metal at once. But after the run in December and the crisis in London, that belief is the most fragile asset left in the entire system. While the West struggles with empty vaults and broken promises, China has been executing a long-term strategy that makes this crisis inevitable. They currently control 70% of global silver refining capacity. This isn't an accident of the market. It's a deliberate consolidation of a critical supply chain choke point. Most of the world's raw silver ore now flows through Chinese refineries before it can enter the global market. This gives Beijing an unprecedented strategic advantage. The implications are profound. Chinese policy can now prioritize domestic industrial needs over international supply. We are already seeing the early effects. Those $8 Shanghai premiums aren't just about local demand. They reflect a new reality. Chinese buyers have first and preferential access to the majority of newly refined metal. International buyers are left to compete for the shrinking portion that remains available for export. As China's own solar panel production, electronics manufacturing, and military technology sectors continue their aggressive expansion, domestic consumption will naturally absorb more and more of this output. The flow of metal to the West will constrict further, regardless of official export policies. This creates what analysts are starting to call the China price. The price within China, driven by domestic priorities and secured by control over refining, becomes the real benchmark for physical metal. The COMEX price becomes increasingly irrelevant, a paper derivative traded in a market that is losing its grip on the underlying asset. The geopolitical dimension is unavoidable. When a single nation controls the processing for a metal essential to the energy transition, consumer electronics, and defense systems, it isn't just an economic advantage, it is strategic leverage. The bifurcation in the silver market is a direct consequence of this concentrated supply chain, and it's a dynamic that Western financial authorities have no tools to counter. This brings us to the critical forecast. Multiple market analysts are now projecting silver prices in the $90 to $100 per ounce range for the first quarter of 2026. Their models aren't based on speculation, they're extrapolating from the data we've just covered. The 7-year deficit, the vault stress, the backwardation, and the strategic dominance of China. They describe a likely pattern of a final shakeout, a double bottom retest around $70 per ounce, followed by a violent upward move as the physical market completely overwhelms the paper suppression mechanisms. But the more significant prediction is the concept of permanent bifurcation. This isn't a forecast for a temporary price spike that eventually settles back to a single global number. Analysts are describing a structural split where the market fractures for good. On one side, you have a China price, a domestically controlled, internally referenced price that reflects the cost of physical metal for the world's largest consumer. On the other side, you have a world price, the volatile, scarcity-driven price that non-Chinese buyers pay for whatever metal escapes the gravitational pull of the East. If this scenario unfolds, it fundamentally rewrites the rules of global commodity trading. Your silver ETF, your COMEX futures, your mining stock exposure, all of these would be priced based on the Western paper market, which could remain persistently disconnected from the price at which physical silver actually trades where the demand is greatest. This is the two-tier system becoming institutionalized. It means that for investors in the West, paper claims on silver could permanently underperform the actual asset. The divergence we saw on December 29th wouldn't be an anomaly, it would be the new normal. The timeline for this resolution is compressing rapidly. Those Q1 2026 price targets are just weeks away. The delivery pressures that drained COMEX haven't been resolved. They were only temporarily suppressed by margin hikes. The London vault system hasn't rebuilt its buffer inventory. The structural supply deficit continues unabated. Something has to give. The system is approaching a singularity where the choices are binary and extreme. Either paper prices erupt upward in a violent convergence with physical reality, causing short-term chaos but establishing an honest price, or physical premiums continue their relentless climb until the Western paper market becomes an irrelevant sideshow for anyone who actually needs the metal. The path of least resistance for the exchanges, continued suppression, leads directly to the permanent bifurcation scenario. They are choosing a managed decline of their own relevance over a short, sharp crisis that would reassert the primacy of price discovery. The trap is set, and the mechanism is now in motion. This isn't an academic discussion. It's about what you own. If you hold a silver ETF in your retirement account, you need to read the prospectus. Does it hold allocated metal with specific bars segregated in a vault? Or is it an unallocated claim on a general pool? In a delivery crisis, that distinction is everything. Allocated metal holds its value. An unallocated claim that can't be fulfilled becomes a negotiation for cash. Even futures contracts aren't safe. COMEX has force majeure clauses allowing cash settlement if they can't deliver physical metal. You could demand delivery at $75 and receive dollars while the metal trades for $95. Your contract protected you from the downside, but it trapped you into missing the entire upside. Mining stocks, however, sell physical production. They can redirect sales to premium markets, potentially outperforming paper claims tied to a suppressed price. Silver is the test case. When a critical industrial commodity splits into two prices, it signals a failure of the entire pricing mechanism. This isn't unique. We've seen similar fractures in energy and other metals. Every disconnect erodes confidence in the Western financial infrastructure designed for global trade. China understands this perfectly. Their development of the Shanghai Gold Exchange and bilateral trade agreements is a deliberate strategy to build an alternative system. When Shanghai sets the real price for physical silver, it means our markets are trading derivatives of a reality we no longer control. The dominance of Western finance since World War II is being challenged not by rhetoric, but by the mechanics of delivery and supply. The choice is between trusting paper promises or acknowledging physical reality. The data in official records, the vault drains, the delivery delays, the Shanghai premium, is your warning. Watch whether paper prices converge with physical or if suppression measures intensify. Understanding this mechanism is the only edge you have. The timeline is closing.